Many traders are familiar with Dow theory, yet a vast majority struggle to apply its principles effectively. Perhaps you've tried identifying higher highs and higher lows, drawing trend lines only to find your trades repeatedly stopped out. You might have entered a position after a price breakout, only for the market to immediately reverse direction right before your eyes. Does this sound familiar to your trading experience? The core issue stems from how this theory is commonly taught as a rigid set of geometric rules focusing purely on lines and patterns. We're often instructed to draw specific lines, connect various points, and then wait patiently for a breakout to occur. However, this geometrical approach diverges significantly from what Charles Dow actually observed over a century ago. He wasn't merely sketching lines on a chart. His focus was on deciphering market psychology, understanding who was buying, who was selling, and their underlying motivations. This crucial distinction between viewing the market as geometry versus psychology is precisely why most traders fail when attempting to use Dow theory. Here's an intriguing fact often overlooked. Charles Dow, recognized as the pioneer of technical analysis, never actually authored a book on his methods. Instead, his insights were published as editorials in the Wall Street Journal during the late 1800s. It was after his passing that S.A. Nelson and William Hamilton compiled these observations into 6 fundamental principles. These very principles went on to establish the bedrock for everything we now understand as technical analysis in modern trading. By the end of this discussion, you will grasp how to interpret market structure, pinpoint your position within a trend's life cycle, and accurately identify genuine trend reversals, all solely through price action. This comprehensive system is built upon 3 essential pillars, beginning with a proper understanding of trend anatomy, a concept many traders misunderstand from the start. Picture yourself standing on a beach, observing 3 distinct elements. First, the tide, which slowly advances or recedes over hours, representing the market's most powerful underlying force. Above this powerful tide, you'd observe the waves, consistently rising and falling, yet always moving in the same direction as the underlying flow. Then, on the surface of each wave, you'd notice small, seemingly random ripples which are largely unpredictable. Remarkably, Dow theory categorizes market movements using this very same 3-tiered structure. The primary trend, akin to the tide, represents the market's overarching direction, spanning from months to several years. This long-term view helps us determine if the market is generally ascending or descending, a judgment made by analyzing the overall swing patterns on weekly and daily charts. A series of higher highs and higher lows signals a bullish primary trend, while lower highs and lower lows indicates a bearish one. Next, we have the secondary reaction, which corresponds to the waves unfolding over weeks to months. These are the counter-trend pullbacks that occur within the larger primary trend, offering temporary corrections. Typically, they retrace about 33 to 66% of the preceding impulsive move, and it's crucial to remember that this is where savvy investors reposition their holdings. Finally, there's the minor trend, like the ripples, lasting mere hours to a few days. Dow himself, over a century ago, labeled these as mere market noise. In today's trading environment, this noise is dramatically amplified by high-frequency algorithms, leading to a common and critical error. If you attempt to apply Dow theory to a 5-minute chart, you're not actually analyzing the market's true direction, but rather getting lost in this misleading short-term chatter. Dow explicitly warned that the minor trend is inherently unpredictable and designed to create confusion. Therefore, your analysis should always be anchored to the 4-hour, daily and weekly charts, where genuine structure resides, as anything lower is simply an illusion. Now that you understand these three distinct market tiers, the next challenge is accurately interpreting the swings within each one, a skill many traders fundamentally misunderstand. Everyone discusses higher highs and higher lows, yet very few explain the foundational criteria that validate a swing point in the first place, a crucial detail that utterly transforms your perspective. The fundamental insight often overlooked is that Dow theory places its emphasis squarely on the closing price, not merely the highest or lowest points represented by wicks. Therefore, a true swing high isn't just any peak on your chart, it's specifically a point where candles both preceding and following it have closed at lower levels. This precise logic for identifying valid structural points applies equally when defining a legitimate swing low within the market. The critical reason this distinction matters is that price wicks frequently deceive traders, presenting false signals of market direction. A rapid spike above a key level only for the candle to close below it is not a new high, but rather a liquidity grab designed to trap participants. In contrast, a candle decisively closing above a preceding swing high signifies a genuine shift in market structure, which Dow theory prioritizes. With these validated swing points now clearly identified, we can proceed to understand precisely how market structure genuinely operates. In an established uptrend, the defining characteristic is that each subsequent price pullback consistently holds above the previous swing low. This means we're not just looking for higher highs, but critically, a consistent pattern of higher lows to confirm the trend's integrity. The moment price closes definitively below a prior swing low, it signals that the underlying uptrend structure has been fundamentally broken. Conversely, within a downtrend, every rally inevitably fails to close above the preceding swing high, forming a sequence of lower highs and lower lows. Should price manage to close above a previous swing high, it immediately invalidates the existing bearish structure of the market. Now, let's address another prevalent error, perhaps the most common one: mistakenly conflating internal chart oscillations with the broader, overarching market structure. Every chart contains prominent primary swings, representing significant turning points, alongside smaller, minor swings, which are mere pullbacks within larger impulses. Treating every minor price dip as a structural breakdown will lead to constant whipsaws. Not every small movement indicates a trend reversal. It's crucial to discern which specific timeframe's market structure you are currently examining. The primary structure dictates the overall market direction, while minor fluctuations are essentially just market noise. To grasp this distinction more clearly, let's consider a practical illustration. Picture a scenario where the price makes a powerful upward movement extending over 3 consecutive weeks. Throughout this sustained rally, there are 4 brief intraday pullbacks, each lasting only a day or two. These temporary retreats, though small, effectively establish 4 distinct minor swing lows on the chart. However, the true primary swing low is found at the absolute starting point of that entire 3-week advance. As long as the price continues to hold above this foundational low, the overarching primary structure remains perfectly intact. This holds true regardless of how many smaller, internal pullbacks may occur during the upward journey. The golden rule is to always accurately identify which swing belongs to its proper structural tier. If the significant primary swing lows are maintained, then the main trend is secure, irrespective of minor market movements. With this clarity, you can now interpret market structure effectively. But the next vital question is, where are you within the ongoing trend? The precise answer to this query profoundly influences every aspect of your subsequent trading strategy and decisions. This crucial understanding comes from Dow theory, which outlines 3 distinct psychological phases within every major market trend. Comprehending these phases precisely reveals your current position, guiding your decisions to buy, hold, or strategically exit. Let's begin with the first stage, known as accumulation, which follows an extended period of market decline. During this time, the news is overwhelmingly negative, causing individual investors to either sell in a panic or completely overlook the asset. Yet, out of public sight, sophisticated investors like institutions, funds, and major players are quietly building their positions. Their substantial order sizes prevent them from acquiring everything at once, necessitating a more gradual approach. Consequently, they steadily purchase shares, absorbing the widespread selling from retail traders day after day within a tight price range. On a chart, this appears as an uninteresting, narrow, horizontal trading pattern, following a prolonged downturn, characterized by low trading volume. Occasionally, the price briefly dips below this range, triggering stop-loss orders and intensifying fear, only to quickly rebound. This isn't random. It's a deliberate tactic, as institutions rely on these triggered stop-losses to create the sellers they need. Next comes Phase 2, public participation, which represents the primary and most significant movement of the trend. At this point, the available supply has been largely absorbed by institutions, causing the price to break out of its previous range with increasing momentum. News reports begin to turn positive, and investors who follow trends recognize the shift, eagerly joining the upward movement. Visually, charts display large candles, clear directional advances, and expanding trading volume, indicating strong market activity. This phase is both the longest-lasting and the most powerful, typically where substantial profits are generated. Finally, we reach Phase 3, distribution, where market sentiment is euphoric. Headlines aggressively encourage buying, and even casual conversations revolve around the asset. This peak of public enthusiasm is precisely when smart money begins to sell, as retail investors, driven by FOMO, provide all the necessary buyers. During this final stage, institutional investors offload their assets, leveraging the overwhelming fear of missing out from individual traders to find sufficient buyers. Although the price might still ascend to new peaks, the rate of increase becomes noticeably diminished, indicating weakening momentum. Trading activity remains elevated, yet the price movements appear erratic and unpredictable, lacking clear direction. An underlying sense of unease often prevails, even as media reports consistently portray a positive outlook for the asset. A critical error, frequently devastating to trading accounts, involves entering the market in Phase 3 under the mistaken belief it is Phase 2. To prevent such costly misjudgments, the single most important factor to consider is the broader market context. When an asset has seen a prolonged uptrend with universally positive news and widespread public buying, you must question if you are entering too late. Another, more subtle pitfall arises because both the accumulation and distribution phases visually resemble each other on a price chart. Each phase presents as a trading range, complete with deceptive breakouts and price movements that temporarily exceed boundaries. The only difference is the preceding trend. A range after a prolonged decline likely signals accumulation, while one following an extended rally indicates distribution. Real-time phase transitions are rarely clean. For instance, a breakout from accumulation into participation might initially fail, with price returning to the range before a successful reattempt. Identifying the exact moment the market transitions from participation to distribution is particularly challenging, often becoming clear only in hindsight. This underscores why understanding the overall context is more crucial than precise phase identification. Your goal is to assess if your entry is early, timely, or delayed. The guiding principle is to actively trade during Phase 2, exercise patience throughout Phase 1, and proceed with extreme caution in Phase 3. While the three phases are understood, confirming their reality is crucial. Dow theory offers a solution most ignore. Volume must confirm the trend. Let's explore what this vital principle, volume must confirm the trend, means in practical trading scenarios. In a robust upward trend, you should observe increasing volume when prices rise during an impulse move, but decreasing volume during pullbacks or corrections. This pattern signals genuine buying interest, indicating that any price retreat is merely a temporary pause, not an actual reversal of the trend. Conversely, a significant warning appears if volume decreases as prices move up and then expands during a pullback. Such a development suggests the trend is losing momentum, with buyers becoming scarce and sellers gaining dominance. However, a practical challenge arises for those trading Forex or cryptocurrencies, as these decentralized markets lack true consolidated volume data. Forex tick volume is, at best, an imprecise substitute, and reported crypto exchange volumes can often be artificially inflated. Therefore, for these decentralized markets, the rule is to utilize volume purely as confirmation, never as the primary trigger for a trade. If other factors like market structure, phases, and overall context align, then low volume during a pullback can still be a positive sign. But it's critical not to initiate a trade solely because you observe a sudden spike in volume. Mistake number 5 is either completely disregarding volume or placing too much reliance on it in markets where its data isn't truly dependable. Remember, volume serves as a supporting element, not the main protagonist. Price action always takes the lead, with volume offering confirmation. With your understanding of structure, phases, and volume, you now face the most difficult question any trader asks. When does a trend truly end? Dow's sixth principle provides a foundational answer. A trend will persist until there is unmistakable evidence of a reversal. However, defining what constitutes unmistakable evidence is precisely where many traders falter and experience significant losses. Having understood structure, phases, and volume, a critical question remains: when does a trend truly expire? This distinction is what sets successful traders apart, as misinterpreting trend reversals can lead to significant losses. Classic Dow theory offers a clear guideline. An upward trend continues as long as price consistently forms higher swing lows. Conversely, the trend is considered finished when price breaks decisively below the most recent significant swing low, marked by a candle close, not merely a fleeting wick. However, the manner in which this break occurs is of paramount importance and often overlooked. There are 3 distinct scenarios to consider when price approaches or touches a previous swing low. In the first scenario, price briefly dips below the low with a wick, but then closes back above it. This isn't a true break. This action is often termed a liquidity sweep by modern traders, where institutions trigger stop losses to fulfill their orders, leaving the underlying structure intact. The second scenario involves price closing below the swing low, yet the very next candle immediately reverses direction. This demands careful observation. Finally, the third scenario presents a strong candle closing below the low, with a large body and minimal wick, followed by confirmation from the next candle continuing lower. This robust and confirmed move represents a genuine structural breakdown, providing unmistakable evidence of a trend reversal. A common and costly error, mistake number 6, is to mistake a liquidity sweep for an actual trend reversal. Traders often panic and sell when price briefly dips below a key support, only to watch it surge back up immediately without them. Institutions deliberately push prices below support to trigger panic selling, allowing them to absorb those orders and fill their own substantial positions. They then propel the price upward, a dynamic known as a market structure shift in modern trading. Crucially, before reacting to any structural break, always consider its time frame. Often, when a crucial low is breached, traders panic and sell, only to see the price immediately rebound without them. This occurs because large institutions require your stop-loss orders to complete their own substantial buying positions. They intentionally drive the price below key support levels to trigger this widespread panic selling, a phenomenon modern traders label a market structure shift, a concept Dow recognized over a century ago. Before you act on any perceived structural break, it is vital to determine the specific time frame on which this break occurred. For instance, if a swing low is broken on an hourly chart, but the daily swing lows remain intact, the overarching trend has not fundamentally changed. In such cases, you are likely observing minor market noise rather than a genuine trend reversal, so always verify the primary structure. A critical rule is never to react solely to a wick. Always await the candle's closing price for confirmation. Furthermore, ensure there is follow-through action and that the break is confirmed on the primary time frame you are monitoring. A truly valid break exhibits displacement, a strong, full-bodied candle that moves decisively without looking back. Without this, it's not a real break. Now you understand the mechanics of how a trend eventually expires, but even before its demise, there are crucial warning signals. Recognizing these early indicators provides a significant advantage, as a trend always weakens before it ultimately dies. This weakening leaves distinct fingerprints on the chart for those who know where to look. There are three primary warning signs. The first warning sign is diminishing impulse legs. Observe 3 consecutive pushes in the trend direction. If the initial push was powerful, the second shorter, and the third barely moved, it indicates the trend is rapidly losing its momentum, much like a runner whose strides are shortening. The second warning sign is deeper corrections. In a healthy uptrend, pullbacks are typically shallow, often less than 30% of the prior move. These pullbacks often don't even reach the midpoint of the preceding move. However, a warning appears when corrections begin to deepen, consuming 50, then 60, then 70% of the prior leg. This indicates that buyers are no longer asserting their dominance with the same intensity, suggesting a significant shift in market control. Our third critical warning sign is failed breakouts. Here, the price briefly surpasses a previous peak, only to swiftly reverse direction. There's no sustained momentum or displacement, merely a quick surge followed by an immediate rejection. This pattern frequently precedes a complete trend reversal. It's crucial to understand that observing these warning signs does not automatically mean you should reverse your current trading position. Instead, they signal the need to adjust your strategy, tighten stop losses, decrease position size, and refrain from adding to existing winning trades. Remember, trend weakness is distinct from a full reversal. A high-probability reversal only occurs when weakness combines with a confirmed structure break. A common error, mistake number 7, is prematurely treating weakness as a reversal, as a trend can often persist for an extended period even while weakening. You should only execute a reversal trade once the market structure definitively breaks, a concept we explored previously. With that, our theoretical discussion on trend anatomy, life cycle, and death concludes. Now, we'll integrate all this knowledge into a practical 5-step framework you can implement immediately. This concise system is exactly what you've been waiting for. It distills the past 12 minutes of information into an actionable method, applicable to any chart or market, ready for your use starting tomorrow. Step 1 involves defining the primary trend. Begin by opening your weekly or daily chart and carefully analyzing the swing structure. If you observe higher highs and higher lows, your bias is bullish, signaling only long opportunities. Conversely, lower highs and lower lows indicate a bearish bias, restricting you to short trades. This initial step immediately filters out half of all potentially poor trades, as you should never attempt to trade against the prevailing primary trend. Step 2 is to identify the market phase. If the market is consolidating in a tight range following a prolonged decline, it likely signifies the accumulation phase 1. Remember to be patient and avoid chasing moves. When you observe powerful, unidirectional candles, increasing trading volume, and undeniable momentum, you've likely entered phase 2, known as participation. This is the optimal period for executing your trades. However, if a trend has extended for many months, public sentiment is overwhelmingly optimistic, and everyone seems to be holding long positions. You're probably in phase 3, distribution. Exercise extreme caution here. Step 3 instructs us to patiently await the secondary reaction. Resist the urge to chase impulsive moves. Instead, allow the market to pull back naturally. Charles Dow noted that these secondary reactions typically retrace between 33 and 66% of the preceding upward or downward impulse. For those familiar with Fibonacci tools, this crucial retracement range perfectly aligns with the 0.382 to 0.618 levels. This specific zone is where major institutions often re-enter their positions, offering you the most favorable risk-to-reward ratio. Moving to step 4, it's crucial to confirm your analysis with broader market context. First, assess if trading volume is genuinely supporting the current trend. Next, observe whether closing prices are consistently maintaining their position, indicating underlying strength or weakness in the market. Finally, check if the primary market structure remains unbroken, signifying the trend's integrity and continued validity. If volume confirms, closes hold firm, and the structure is intact, then you have a clear alignment of factors, signaling a potential trade. However, if any of these critical conditions are not met, the wise course of action is to simply wait for better, more confirmed opportunities. The fifth and final step is to execute your trade. Enter in line with the primary trend, specifically during the secondary reaction, and only when the market is in phase 2. Position your stop-loss order strategically below the most recent identifiable swing low to protect your capital effectively. Continuously trail your stop as the trend establishes new swing lows, and prepare to exit your position when the market structure decisively breaks. This break is marked by a swing low being breached with a clear close and displacement. These 5 crucial steps — define, identify, wait, confirm, and execute — represent Dow theory applied not as a mere academic concept, but as a comprehensive and actionable trading system. This entire methodology, encompassing definition, identification, waiting, confirmation, and execution, transforms Dow theory from a concept into a robust trading system. Having explored this comprehensive framework, let's now step back and consolidate everything you have learned throughout this video. We've covered 3 fundamental pillars that underpin market understanding and effective trading decisions. First, the anatomy of market structure, teaching you to correctly interpret valid swing points, closing prices, and the paramount importance of primary structure. Second, the life cycle of trends, revealing the 3 distinct phases: accumulation, participation, and distribution, where smart money operates and trends conclude. And third, the death of a trend, understanding precisely when and how reversals occur, distinguishing real breaks from mere liquidity sweeps and recognizing fading signs. All these insights are seamlessly integrated by that powerful five-step framework. Define, identify, wait, confirm, and execute. Dow theory isn't about drawing lines on a chart. It's about deciphering market psychology, understanding the intentions of buyers and sellers. And now, you possess the essential tools to precisely interpret these underlying market narratives. This theory, over 130 years old, is now sharper and more applicable than ever before, especially after what you've learned today. If this presentation has illuminated Dow theory for you in a completely new way, please subscribe and enable notifications so you don't miss our next video. In the upcoming episode, I'll apply this entire framework to a live chart, guiding you from a blank screen to a fully developed trade plan. You will see firsthand how these 5 crucial steps function with actual market candles, providing undeniable clarity. Before you go, share your thoughts in the comments below. What was the most significant Dow theory mistake you've made in the past? Perhaps it was one of the common pitfalls we explored and demystified together in today's comprehensive guide?